So, how are you guys? This is Praise FX, and so it's been long without any update. So today we're going to talk about something called a retracement. So, in usual terms, as we all know, what is a retracement, right? So a retracement, sorry guys, a retracement, it is a move after an impulsive move. We get it. So to understand a retracement, you need to understand what is an impulsive move. We take an example, is that let's imagine that price has moved. I'm just going to use this highlight that price has just moving in certain ways, then it pushes away, and then this move, this is what we call a retracement. So I'm just going to use some clear pencil here so that it can be more much visible. Get it? We just imagine that where price has been trending the upside, it creates the low, the high, then it retraces, then this push, it is what we call an impulsive move, right? In simple terms, an impulsive move, it's a move that breaks the previous low or high, depends the trend you're in. Let's imagine that we're in a bull trend. That means an impulsive move, it's the move that breaks out the previous high that was created, as also the same time it forms a new high. You get it? So that is an impulsive move. Then what is a retracement? A retracement, it is the next move that comes later on to fulfill or to mitigate maybe either some space that has been left behind, maybe the imbalance, or either price comes to do what? To fill leftovers so that it can either push away or violates. So a retracement, in most cases, it always results into two things. It either comes and becomes rejected, it continues its move up, or it comes and violates the previous low. That means now there is change in the trend. Now, to get these things more clear, it is how do you easily identify them? So in most cases, an impulsive move, there are always there are always consecutive candles. That means consecutive 3 candles, or candles of same color or of the same move being dominant, right? Let's say, take an example, you're in a bull trend, and most people will know what the color we use for bull trend. Maybe it is always blue or green, right? That means in an impulsive move, you're going to see a lot of dominant blue candles, less than the 3 bearish candles, right? And they're going to be big candles. And the difference with that, what shows that it's a retracement, there are always a lot of short candles, very mixed with blue and red, or you can call it with the buys and sells. You get it? And they do not make that normally quick move. You get it? Because price is still trying to fight to oppose the previous candle, the previous movement. So when it's likely to happen that, and one of the confirmation to see that your retracement, it is not going to, your trend is going to be violated, the moment you see your retracement is starting to be, let's take an example that price breaks this high, creates a new high, then it is supposed to be moving like this as a retracement. But the moment you see this bold move, just know this, your trend is going to be violated, and the next move, they're going to be a change in trend. In short terms, a retracement is supposed to be so much simple, and it should really show that there is force being fought so that it can conceivably preserve that trend. You get it? The moment you see something like that, just be aware of that. Now, our main topic is today is how can you trade a retracement? You get advantage, right? sorry, if you're a beginner, it is not advisable. I'm so sorry, I'm kind of so weak, so just bear with me with my voice. So it is not advisable to trade a retracement, but why not if you're used or if you're an expert on it? Because take an example, you're going to have a trend like this. Maybe this becomes your most recent price action, of which maybe this would be on the daily and an H4, and you find yourself that inside you might get some trend. You get it? You might get some trend because you are a day trader or an intraday trader. So you get some small things you take. Maybe your target is always simple. You get out of the market. You wait for another move, another chances. You get it? As someone is waiting for price to come back into his direction and take a good trade for you, you have managed to utilize both the sells and the buys because you understand when do the sellers come in, when the retracement come in, and what is an impulsive move like that. Then you also wait a move here, you also be buying. You get it? So in most cases, how do you trade a retracement? First of all, you have to know the time frame you're basing on, right? And what you're dealing with. That means if it's daily, let it be daily H4 at 15. If it is 15, let it be 15 H1 and 5 minutes. If it's H1, let it be H1 30 minutes. Like, it's not specifically the interval that they must be the same. It is price giving you what is so much convenient with your side. Is it me more convinced? But now we're just going to take a little bit of an example. That was just a diagrammatic illustration of how you can do what you can trade a retracement. Now today this is Euro USD, and we're just going to take an example on this chart, right? So this chart, I'm just going to zoom in and zoom out. Let me first move all the drawings. Okay, now we just want to see, without even bringing all different charts or all zooming out the entire chart, we're just focusing on this. So by all means, what we have here, or what we understand here, is the price is pushing up, like it is still in an impulsive move, right? So we just have to focus on the most recent price action. So what is the most recent price action? The most recent price action, it is that price created the low, and it also created the high. It created the low and created a new high, right? So in most cases, in most cases, price is supposed to come back at a certain level there, so we can validate either we are continuing to buy or we are either continuing to sell. So that does not bother us, because what bothers is just, can we try to make something out of the market this very day or this very week? Okay, now what I always want to tell people is that you focus. You can trade both sells and buys, but having that in mind, right? And I don't know if maybe some of you have been taught, how do you confirm a retracement? I think that will be our next class before this, after this, because it's something that looks small but it's kind of weird thing, right? It's something that is huge. So in most cases, what do we have to understand here? We look at to this chart. This was the break of structure, right? Let's just focus on the most price action. That means the price action, it is the most trend. But remember, we're on the daily time frame. Why are we doing this? We just want to be clear with our mind, to know where maybe our limits might stop, right? If this is the break of structure that last happened, and if we bring our Fibonacci tool and we set it, that means the nearest option that might come in here, at least in most cases when you're trading a retracement, the highest target that it can go, it is the 15 minute, right? It's the 50 time frame. So it's like you target, I think I'm supposed to remove that, right? Let me just make it black, and the boldness So let me make it black. Okay, so I'm like, if you're trading a retracement, you just have to mainly, the highest target that you can go is the 50%, because you don't know whether price is going to respect the retracement or is going to reshuffle it. But at least you know, whatever, however much price retraces, it has at least to sit at least 50% of the price. But that's when the price you have confirmed with your confirmation retracement. Now, what do you have in mind is that as price was pushing up, yeah, well and good. What is the nearest thing that we would be looking at here? Yes, first of all, it created that high, and second of all, maybe the imbalance and the fair value gap might come in line also, just to assist that. But maybe that would be like one of the targets. But let's first just remove it. It can be like a by the way, just to be used as what it can be used as a by the way, or maybe we'll use it in as a TP. You get it? Now, what do we have here? So we normally understand that if price has been pushing up, it created the new high. So this was the new high that created, you get it, and then price started showing rejectional candles, but till price had not yet resulted to the confirmation of the candle. Like, we need at least price to push below and closes below. That is only the confirmation that now retracement or people who push price down might be so much interested now in the market. Now, this is what we wanted to see on the daily time frame, of which you would see that this candle, I don't know if my images are so much clear, but I always try. Let me just scroll it. You can clearly see that this red candle, it is the one that did what? Broke structure below. It's not structure, it's like kind of a confirmation. Remember, retracement are so for short time. Now, in most cases, what we are looking at the same time, we're just now going to dive, because this is the daily time frame. We have to dive at the H4 just to look for more capability and more clear things, right? So what do we have here? Are you seeing one of the concepts that I always tell people, when you're doing your top-down analysis, you have to always make sure that your higher time frame matches your lower time frame. Now, when you see in this clear example, you can see that price came, created the high, of which it was a rejectional candle. Let me try to zoom it so much well. You would clearly see that it was a rejectional candle or an engulfing candle. So this is not an engulfing, sorry, it's a hammer, right? An inverted hammer. So this was a sign of that here there were reaction of sellers, and now they might, it like was a little bit of a confirmation. If we are much quick enough, maybe we would have entered at this level, but we always want to enter where you have got reaction. And if you look in time, you realize, if you go back on your charts, you realize that here at this level price reacted. When you go back in time, you realize that there was a certain order block sometime back, but our mainly focus is that we are focusing on this. Now, when it becomes at the H4, what are we trying to look at? You realize if price went this high, then it kinda created, I don't know if I'm so much clear, but you can realize that price came, created a new high, you get it, then the low, then a lower low, then a lower high, sorry, then a lower low, then a lower high, then a lower low. You understand that? Then the lower low, then the lower high, a lower high, then a lower low. You get it? So now you can understand that clearly this was an impulsive move. You remember those things that I told you, that an impulsive move, the one that I explained, that it's normally very huge momentum candles, or like it does not stick around, like it moves aggressively, right? It moves aggressively, and then a retracement is just going to be that kind of weird thing. Regret it. So the use of a retracement is just to give also chances to other some traders. You get it? Because I know people who trade only impulsive move, and to trade retracement you really must be so good at what you're doing and understand what you're doing. You get it? Now if we remove this, you see it was like kind of a trend, but for us we cannot just come and enter here because we really understand the concept of liquidity. You know that these are buy side liquidity, that however much price will have to first come back and clear that. So someone who is really not much at deepening things inside, he'll maybe just come here, set his enter his loss, his sales at the moment, then target those low, of which is not bad, but at least we always want to try, we always want to catch a good move. You get it? Now for us, what we are looking at, we just want to be patient. First and foremost, we first want to see this buy side being cleared so that we can get any other opportunity. You get it? So now imagine there are some people who here they entered sales, but they didn't see that there is this trend line liquidity, and of which we, when you're trading, we at least exactly, you see, it is patient, nothing much more that icing. Remember this line that we marked there? This was the first imbalance that we had marked. The imbalance line that we marked from the daily. You get it? Now icing how this imbalance line comes in line that there is also an H4 imbalance. Sorry, it's here. Sorry, it is supposed to be this one. Icing, I told you that that would be maybe one of the targets, but those people who know me, why I tell them to trade imbalance, it is when maybe price gives you structure. You get it? Like a clear structure shift. So price tapping into your imbalance, like the imbalances are so that much risky, of which in most cases I really do not advocate for them. Exactly. Now are you seeing here on our H1 just a little bit, just until where price tapped into that imbalance. So the class was, this video was talk about, it was talk about how we can trade the retracement, but I've also got another thing. So the way this, how you can trade or get a trade actually afterwards an imbalance. So this is also another way how you can trade when price taps into your imbalance, right? You'd clearly see that this was the last push, price came tapped into this imbalance, it then cleared this trend line liquidity, then boom. You see, remember the imbalance is only invalidated. So now remember this is our H4 imbalance, but we are on our H1. We want to see how it's going to react. You get it? So price comes here. Of course it shows that now momentum again has shifted from the sellers, turns to the buyers, it comes, clears more of this, then boom, now here we're also waiting for the confirmations, it again sweeps more. So when price sweeps that much more, we have to enter at this level. In most cases, I always enter the moment I see that one, I always target this, the high that was created and the stop loss there. I do not always focus like harden my things, so just let things play out like that. Okay, so you can see that a 1 to 3, very simple trade. That's how you can maybe trade an imbalance inside of a retracement. That means that you waited for your imbalance to come, boom, price reacted on it, of which you are not like these people who just enter and set limits, because you can only set limits maybe when you don't have time, but when you have time, wait, because remember it's an imbalance, a fair value gap. Price have to react on it. You see, there is nothing works automatically. Price has just first react. Remember, this is an H4 imbalance. We're on the H1, price come, taps for the first time. It has to first come, clear this sell side liquidity, the buy side liquidity. So whenever price clears the buy side, that means the sell side will also coming for you. You would clearly see that it came the moment you see almost near 2 weeks of the same candle, almost near or same, just know that's a liquidity grab. Price has come back there. As price came, tapped into it, are we together? Then boom, price went back. Icing, then it tapped into that was a 1 to 3 anyway, and it was so much clear and simple. Anyway, now let's first we go back to what we are talking about, of how we had to manage to wait for. Remember, you're still inside this, so you only get used if you're a day trader. That means you're utilizing each and every move. You're not only going to wait for many things to come at a certain time. You get it? Now when we come back at the wait for, remember we're waiting for price to come and clear this, all this. Remember, it has just cleared. Now we want to see another confirmation of price tapping into there and gives us another formation that now I want you to watch this thing clearly. Remember, this is a zone. This was like the daily candle of daily time frame. Now what are we looking at? You see, now for the first time price taps into our zone. You get it? Price taps into our zone, but the last bullish candle, it is this one. So in order, the last bullish candle, it is this one. This is its low, right? So in order to go to another time frame or to enter, we just need to first see this being taken out by the bearish candle. You understand? With momentum. Now what happens here, it is that price comes in, right, breaks below. So whenever price breaks below, that means there is this still this high that was created. So in most cases, what normally many people do, they, yes, after seeing this, they know now this is our first option. We just have now, we have to do what? To enter. Yes, we normally enter here and put the stop loss, of which there's something that I've talked behind. If you're seeing these almost equal highs or equal highs, these are now triple highs, of course price has to first come back for you. You get it? Or if you're much brave enough, you can enter here, put your stop loss at this zone and target all that. But remember, all that takes will be shortening what? Your risk to reward ratio. Are you getting it? And exactly, you see, this is what happened, is that price came in, tapped, cleared that, it came in faster, I think it came in price, this was the move, it cleared this, then it eventually came back directly. So still you have to repeat the same process. This was the low, you get it, the weak low. So you normally have to put your trade here. I normally enter at this moment. Yes, since it's a 15-minute chart, I just put the stop loss there, right? And maybe I can just try to, because since it has equal highs, I can just to stretch it just a little bit. And now, how am I going to first get my targets? I'm just going to go on the H4 because this is what I was basing on. So when I go on the H4, this will be my first target. I'll be targeting that low, of which you could see it's clearly a good to a 1 to what? A 1 to 4 risk to reward ratio. You get it? And second of all, how do I get my other TP? I normally put this is what I normally use, just target the previous low and high. Maybe with time I would maybe target this low, but as long as my first tip is being hit, that's all enough. That's all what I want at the moment. The rest can be worked on. You get it? Now when you go back at 15-minute, you see this is a 1 to 7. You get it? Even if we stretch it much enough here, it will be a 1 to 4. So now in most cases when you have a scenario like this, you always have to leave it to the maximum, your stop loss. You get it? Then you wait to see how price, just not to be evicted and to be on the wrong side of the market. Now let me just remove these indicators and increase the speed. I really think price played around this level, but it again came back. It now created a new structure. You get it? And what people normally do, it is that they forget that whenever price breaks structure, it has to come back and retrace. You get it? But for many people, when price breaks structure like this, they normally put their stop loss there. Now for me, what I'm going to do, since now I know that price has now created a new leg, now this is when I start reducing my stop loss. I think not until it gives me more further. The more it stretches, then I'll just bring it at that height, just a little bit. And that means if it hits my TP1, if I had 2 positions, I close 1, then the rest it is at a break even. So whether it goes back or whether it releases, I don't care. You understand? As simple as that. Boom, it hits TP2. You call it a day. You get it? I think how these things have come in line. Remember what I told you, that however much you're good at, remember you're trading a retracement, what you have to keep in mind is that this, remember where we marked this? This was on our daily and we marked it as our 50% of the price. So however much you can say that, but we can't go below that, because remember the overall structure was what? Was a bull. As simple as that. So I think someone learns out of this thing. We meet next time. Bye bye. I sign out.